Welcome to the show, everybody. My name is Emil Kalinowski. I'm joined by Daniel Want and special guest Sean Maher. We're going to be going over lithium, the fundamentals of lithium, supply, demand, the outlook. What does it look like for the next 10 years, let's say? But the question, Daniel, that people may be wondering is why did lithium come up on your radar screen? Why do you want to learn about the fundamentals? Give us a little brief introduction overview as to what you're seeing, and then we're going to introduce Sean properly and dive into the fundamentals.
Yeah, well, lithium has been getting a lot of attention in recent years, especially in some of my broader client base. It come up quite frequently from time to time, and when we drop some of the lithium related, equities and all of this sort of thing into a lot of the different modeling that we do, particularly around underlying liquidity and different participant sort of implied flows, it's sort of at a juncture right now where probably I'm jumping the gun too much here, but
jump it face first.
Yes,
no mercy.
Face first. So it basically appears like there's the bare minimum requirements necessary in terms of retracement, even accumulation from some of the larger sort of moneyed crowd. However, there's also enough warning signs here to suggest that we haven't really seen the lows in a cycle or sub-cycle that's unfolding presently. And so, if anything, it appears a little bit actually too premature to even be looking to be accumulating presently or earlier in this year when we started to get some of those normal sort of washout in liquidity and accumulation sort of in the larger money flows that we track. And so I thought it'd be intriguing to talk to someone who has a lot more expertise in this area globally, especially, just to try and get a bit of an assessment what's going on, supply and demand. I thought towards the end of this discussion, actually, we might do a bit of an exercise where we sort of, we put Sean on the spot a little bit and just say totally anecdotally and, completely discretionary type observations. I was going to describe a few different participant categories just to try and see if you knew anecdotally what you thought they were doing and why. Mm-hmm. And then we just triangulate back towards, what picture that sort of implies for this particular market set,
no
so to speak. And just see where that ends up, what that ends up looking like. It'll probably make a lot more sense as I start to talk through this or the questioning towards the end of this discussion or after we actually have a bit of a survey of sort of more fundamental supply demand conditions. And we just see what that looks like and where we end up in that sort of a discussion. When I do this in different industries or commodities or with different subject matter experts, it's always very intriguing because a lot of the theory around what I'm trying to do is, there's different categories of participants around any given market, some with greater access or proximity to information, some with different balance sheet capacities, different levels of experience, sophistication. And each of those sort of archetypical type groups tend to relate to a cycle in any given commodity or market or industry in fairly consistent ways, either pro-cyclical, counter-cyclical, in a few different things. And so when we triangulate that back, even with some of the different analysis tools that we have, we start to get a little bit more of a three-dimensional picture or glimpse of what is going on in that underlying commodity or market or industry in question. And I thought that might be an interesting thing just to explore, to see if anything comes up towards the end of the chat.
Okay.
Sean, I saw you for the first time on Russell Napier's ERIC, which is a research service for professional institutional investors, which is primarily or exclusively where you focus and release your information and share your knowledge. So it's wonderful to have you, that you're on this show with a more retail audience. You do post elsewhere your thoughts about markets. So tell us a little bit about your work, your company, and where the broader public can reach you, as well as in case there are any institutional investors watching.
You're right. Basically, our focus is hedge funds, pension funds, sovereign wealth funds, family offices, Asia, Europe, US. Built this business up over the last 20 years. I was formerly at Nomura. I was formerly a fund manager. So I've been around the block before I started my own business. And it's word of mouth, basically. I've got a couple of outsourced sales guys, but mostly it's word of mouth. One manager tells another, they go on trial, and the conversion rate and something like the Eric videos was very high. So that's nice business. I don't do retail for a lot of reasons, including compliance. And the price point is quite high. It's $15,000, $20,000 annual subscription. Basically, the energy transition is one, we focus on where macro and technology intersect and where that creates opportunity. That's our big thesis, right? Most economists and central bankers don't look enough at technology shifts and how they impact macro, be it inflation, be it terms of trade affecting FX. I mean, right now, for instance, you look at China, where the export numbers are blowing through all-time records. They're heading for $1 trillion trade surplus this year. And that's only partly because of domestic weakness. It's partly because of the fact they are beginning to dominate the clean energy transition. They own the battery space. They're going to own the EV space because their price point is 30-40% cheaper than a Volkswagen or a Tesla. So you look at that and you can see how they're doing what Korea, Japan did in the 70s and 80s, and it completely changes. I mean, everyone's focused on the slowdown in China, all the stuff on property, but people are forgetting that they have a very clear 2025 ambition and then a 2035 ambition to be the OPEC of green energy, to control the entire supply chain, and that includes lithium, which we'll come back to. So we focus on these themes. Semiconductors, the rising semi-intensity of car manufacturing is a big theme of ours. Companies like onsemi, Wolfspeed, all that kind of stuff. But I think this lithium story and this battery story is one of the most important anywhere right now. And it includes grid storage as well as EVs, right? How on earth, when we switch to renewables, do we actually, underpin grid resilience via mass storage? Lithium-ion is the only solution. So grid is going to be competing with autos for available lithium supplies, for available cobalt, etc. supplies. So to just frame where we are currently in lithium, whether you're a climate change denier or not, you've got to accept the world auto fleet is going to electrify in the next decade, right? We're at 20% plus in China. We're heading into the teens in many European countries, and the US, post the clean energy bill, is clearly going to get to those kind of numbers by mid-late decade. So we're going to electrify. Every car maker has announced very ambitious plans. A lot of countries have announced plans to phase out ICE cars by 2030, 2035 kind of time frame, at the latest 2040. So it's going to happen. And the question is, how does it happen? How do we get the resources necessary to make this a reality? Now, just 2 weeks ago, the IEA, International Energy Agency, published a big review of this transition and the resource intensity of the transition. And they came up with 50 to 60 new lithium mines required by 2030. Investment to make those mines a reality is in the order of $45 billion, which I think is an underestimate. But let's just take that number, 45, 50 billion, 50 to 60 new greenfield mines, be they in Australia, where we're talking about spodumene, which is the hard rock source, or be it in the kind of lithium triangle, Bolivia, Chile, Argentina, which is salt brine. Either which way, huge investment. And this is a filthy, toxic, water intensive process. Clean energy is a dirty process. And that's one of the kind of myths about where we're headed. It's energy intensive and it's a very dirty, polluting process. We're going to talk a bit about the refining process and why China is going to continue to dominate that, even if the West can build up lithium capacity in places like Australia, Canada, and within the US itself in places like Nevada, as Tesla aspires to do. But I want to just frame this as, okay, we're going to electrify. We're going to be producing 30, 40 million annually EVs in the world by late this decade, early the next decade, right? So probably at least half of total global production will be electrified by 2030, 2031. That's where we're headed. To get to that, as I said, we're looking at this massive increase to 2 million metric tons a year of lithium production. The US alone will probably consume a quarter of that. And the discussion is going to be, I guess, later on, as your speaker asked, where's the investment opportunity and which companies, which kind of mining plays are going to be, leveraged to that story. There's 4 problems I want to address first off. First problem is battery recycling. Companies like Redwood, which have tied up with Ford, and there's several other companies in this space now, which are putting billions into technologies that allow us to more effectively recycle batteries as they basically end of life. 13 to 15 years is a good estimate for how long a car battery will last, basically. So as we build volume currently, these cars we're now selling, these Teslas in the last 2 or 3 years will come back to the market into the mid-2030s, and they will get recycled back into the new car production chain. Now, if you're building a lithium mine, you've got a 10-year lead time. You get a 10-year lead time. It comes online. If you start today, say 2030, 2031, will be a very good result. You then have recycling kicking in by the mid-2030s, late 2030s, as becoming a dominant source of lithium. So your payback period is going to be, at best, a decade. And that's without even talking about solid-state batteries, which we'll come back to later on. But you basically, when you build a project out in lithium right now, have got 2 massive competitive threats from battery recycling, which obviously relies on current lithium production ramping and those batteries getting into the market, and from solid state, which is a polymer electrolyte and doesn't require lithium in the production process. That's still mid-2030s beyond technology at the moment. It's lab stuff, and it's going to be small forms like phones and stuff initially. But that's very important because that then sets the price point. Your internal rate of return has got to reflect the terminal valuation risk when you build a new lithium mine, right? Lithium mines may not exist by 2040, 2045. There will be no need for them, basically. So this is very important to understand. The second issue is sequencing. So we have a global electrification of autos shift where you can build a gigafactory in 2 to 3 years, right? You can throw $1 billion at building a huge new gigafactory in Texas or in Germany, and they're all doing the same thing. Northvolt, I mean, there's a dozen companies now building gigafactories. CATL is just building a new one in Hungary. That's pretty fast. You can build a cathode or an anode factory to supply those gigafactories in probably 18 months flat. If you're someone like Umicore in Belgium, right? Fine. The big bottleneck is the mines. The mines are taking you 10 years plus to get online. So there's a massive disconnect between how fast we're building out the battery capacity and the components, the separators, the anodes, the cathodes, etc., and the raw materials that go into making them a useful product. And that sequencing is where the investment opportunity lies right now, I think. And the Chinese completely get this, which is why the Chinese are vertically integrating all the way back to mine level, from the EV all the way through battery like BYD, all the way through to domestic mines. And the Chinese are now developing. And this is why Goldman Sachs put out this note a couple of months ago, this stupid note in my view, which said, oh my God, we're going to have a new crash in lithium prices like we got in 2018-20 because the Chinese are massively investing in new domestic capacity. Yes, they are, but it's low quality, low grade ore, which will not yield anything like what the Australian and Chilean ore bodies can supply. So the overcapacity thing, I don't buy it, right? It's also important to remember there is no one lithium price. We see the spot price quoted at us on Bloomberg screens, and the spot price in China in particular, right? And that's gone up, whatever, 8-9-fold in a year. Phenomenal numbers, right? Gone ballistic. And no investment bank saw that coming. They all extrapolated the 2018-20 bear market ad infinitum, despite what was going on in EVs. Most lithium is bought on contract. As those contracts expire, they're starting to reflect the very high spot price, which is why most car makers, including Tesla, BYD, whoever, are raising the cost of EVs 5, 8, 10% to reflect the higher battery costs. So battery deflation as a trend is now over because the cost of all the inputs is going up substantially. Now, it may well be you see a correction in spot lithium prices. The Chinese government certainly wants to see one because it's a threat to their ambitions in building out the EV sector. But one way or another, as I said earlier, you're going to have a very high price over a very long period to justify the investment given the terminal valuation risks. So we're not going to get another 2018-19 scenario in lithium, in my view. Put that to one side. It's not going to happen. And all the supply risks, all the overcapacity risks, I just don't see them as in any way serious. The other side of the equation is far more likely undersupply and a crisis where a lot of car companies are doing a trapeze act and there's no safety net. And as they jump from the trapeze, there's nothing beneath them because they cannot get the battery supply to meet the EV targets. And the outgoing CEO of Volkswagen, actually, at the FT Future of the Car conference about 2 months ago, said exactly that. He said semiconductors are not the big issue here. It's battery supply. If we can't get raw materials for batteries, we are out of business in 5 or 10 years' time, especially against Chinese competitors like Geely, like BYD, even Baidu with its Apollo robotaxis, which have got absolutely guaranteed supply domestically. So getting hold of the battery at a competitive price is going to determine who owns the EV market in 10 years' time. Musk gets that. A lot of auto CEOs still don't get it. They're being incredibly complacent. They assume the market's just going to deliver this, and it's just going to happen. It's exogenous. That's not what's going to happen. They're going to have to take control. And in a way, the car industry is going back to Henry Ford Model T era stuff. And if you recall, he used to smelt his own iron ore in Baton Rouge and ship it across the canal to the actual car factory and make it into sheet metal to build a car with. He even went down to the Amazon and tried to build rubber plantations. And if anyone's ever read that book, Fordlandia, that turned into a disaster. But the concept of having total control over the supply chain to make sure that your price point was totally competitive and no one could touch you is exactly what every Chinese car maker is now thinking. And the EV shift is a way for them to basically grab market share, to gate crash the market. So this vertical integration idea, where you have to control batteries, the gigafactories, all the key components, right down to the lithium supply, is very important. I guarantee you, Ford, GM, all the major car makers will be co-investing in new mine capacity. They will be buying 30, 40% slugs of mines, either through some sort of takeoff where they guarantee they will take, the outtake for 10, 15 years plus, or directly investing like they have in solid state startups with capital injections. Car companies are going into the mining business. They have got no choice, in my view. And that's a huge change, basically. Clean energy is being dirty, as I said earlier. Now, ESG is a major problem for lithium mining. And when you invest in the sector, you have to be very cognizant of the risks. In Chile, in next month, you have a referendum, which is going to look at a lot of aspects of their domestic mining industry, particularly the use of water. They've had a drought, which has gone on for almost 20 years now, far worse than anything in the US Southwest. And politically, that is a very charged issue. You're using about 70 to 80,000 liters of water for every metric ton of lithium. Right? Now, some of that gets recycled back afterwards, but nonetheless, using brine, salt brine, and using those filtration ponds, which take 18 months to 2 years to actually extract lithium carbonate from the brine, that is a kind of limited process in an ESG world because of that pollution issue and because of that water offtake issue. If you go to Australia, if you go to spodumene, hard rock, that is an electromechanical fossil fuel intensive process, which is in total, including shipping to China for processing, about 3.5 times more carbon intensive than using Chile or Argentina or Bolivia. That is an incredible number. So it goes back to my point. Clean energy is dirty at inception. It's fine to say solar or wind or whatever, marginally the cost is zero and it doesn't generate carbon. Getting to the point where we can actually build capacity incrementally is a very dirty process at every level. Materials intensive, energy intensive, and carbon generating. So ESG wise, would you say Australian lithium is equivalent to Chilean lithium? You can't say that because you have that carbon aspect. And I think that's going to be very important in the way projects are funded, in the risk premia, all that stuff in the next few years. So keep that in mind as well. Fourth point I want to make, and this is a very important point. Imagine somehow the capital arrives from car companies, from the Biden administration, from wherever, to build up a Western lithium industry, right? So mining, which is not controlled by China, because right now, most lithium projects have got some Chinese investment. Tianqi is the biggest lithium miner in the world. It owns a chunk of SQM. Just last month, you saw Ganfeng Lithium, which is the second player after Tianqi, listed in China, go off and buy another Argentinian mine for almost $1 billion to get hold of salt flats production down there in Plata. They own anything that moves in the lithium space. So if you're going to create new virgin greenfield lithium sites, which have got no Chinese involvement, which are geopolitically secure from Chinese control, then you've got a bigger problem down the road. You build a mine in the USA, in Nevada, in Canada, how do you refine the output into battery grade lithium hydroxide to go into a gigafactory? Because right now, 80% roughly of global refining capacity is in mainland China. Now, to just give you an idea of how difficult this refining thing is, Tianqi has a deal with an ASX listed company called IGO in Australia, and they were building a refinery in Northern Australia, right? 25,000 metric tons a year capacity refinery. It was meant to come online in 2018. It just came online last quarter. It's not going to reach full capacity to 2025. Now, this is with an Australian company being handheld by Tianqi, one of the most experienced players in the world in refining lithium. And it still ends up 4 years late, way over budget, and falling way short in production targets. How on earth do we think the US, Europe are going to possibly catch up with China in the next decade in the process of taking lithium from a mine and getting it into a battery? It's just not going to happen because we don't have the process knowledge. We do not have the material science engineers, the chemists, and the process engineers at every level to make this happen. This is accumulated knowledge, and unfortunately, the West has given up on manufacturing, given up on mining. Really, bright young kids do not go into these sectors anymore, and that's a huge problem in terms of the ambitions now from the Clean Energy Act, etc., to secure the supply chain. So I think those are four issues, just four big themes in terms of the carbon stuff, in terms of refining, in terms of how do we fund the lithium and the vertical integration aspects of the whole supply chain, which I will throw at you. And you can come back at me in terms of clarifying or in terms of, maybe disagreeing.
I'm overwhelmed. I've got a whole page of notes. And of course, there's no time to dive into any of them. So I'll just pick one. Sean, the war in Ukraine with Russia, Belarus, has that in any way slowed down the movement towards electrification? Has it said the most important energy, the one that's most immediate, are carbon-based, natural gas, oil? That's what we need to focus on, not 2030, 2040 electrification of our cars. Has there been any sort of change in narrative from governments about the immediate effects of energy shortage?
There has in terms of the grid, because you've obviously switched coal, you're switching from gas to oil in terms of grid generation in Europe as an interim measure, just as an emergency measure. Finally, the Germans have given up on closing those 3 nuclear plants, which was just an insane policy, basically. I mean, our view on nuclear, we're hugely bullish on nuclear and uranium because ultimately, on a whole life basis, nuclear is lower carbon than wind, solar, or anything else because it's a 50-year lifespan. These things are 15, 20. And that is a huge, huge factor, which is not in most of the models. So nuclear is, and the Chinese are building 18 new reactors. They got 200,000 engineers now in the nuclear industry. Average age of those engineers is 30. The average age in the US is about 58, right? So they are pushing hard and they're developing new models. In terms of electrification of cars, it hasn't. In fact, if anything, I think it's just accelerating the trend away from, we don't want to be reliant on Saudi, we don't be reliant on Russia, on autocratic regimes, which can turn the taps off at any time on a whim. So I think the idea is that once you build out the gigafactories in Europe, once Volkswagen and Peugeot and whatever electrify fully, and we get through this interim phase where people are going to be laid off, where the factories need less workers, it's a simpler process. Once we get through that hump, we end up with a situation where we are more energy secure. We don't import all of, and then at the end of the day, we've got no choice because for a very simple reason, we are losing every couple of years about 1.5, 2 million barrels a day of refining capacity. Nobody is building new oil refineries. So if we don't do anything, right, we will not be able to we won't be able to run new ICE cars in 10 years' time because there won't be enough refining capacity to provide the diesel and gasoline. As we saw recently with obviously what happened with crack spreads and the price of gasoline in the US. So we're running down the fossil fuel infrastructure. We've got to replace it with something. And solar is at a boom year in Europe. Who's making the solar into Europe? It's China, of course. So yes, we're using more coal. Yes, we're using more gas in the very short term just to keep the lights on. But ultimately, it's accelerated the transition push.
Daniel, let me throw it to you. Your questions.
It appears like we're either in or going into, just zooming in on the shorter term, a some form of recession in the world, or recessionary type conditions from a growth perspective. A lot of so you've got the lithium story in its own right, but then you've got the demand story, which is joined at the hip, in a lot of the EV, the cars, the whole works.
Yeah.
And so we still see a lot of correlation overall with economic growth conditions and demand conditions, and that largely, from my viewpoint, seems to be is what has ushered in sort of the pause or the weakness in this sector to make this potentially an interesting area to revisit over the next several quarters or over the next year or two, to be accumulating potentially a sizable allocation to this.
Yeah, and then the same goes for copper. Same goes for copper, which is far more cyclical, obviously, in terms of the recessionary risks and growth slowdown, right?
Yeah, and so that's obviously what you're seeing, because that just keeps coming through, and I'm just wondering what I'm missing because it seems too simple. But
no, it is. But look. Right now, year on year, total car sales in China are down. The consumer in China is flat on the back. They're selling their Rolexes. They stop start. COVID stuff is still going on. Confidence is terrible. But within that, new energy vehicles, including plug-in hybrids and full electric, is still growing like topsy, and you're getting more incentives for that because the government wants that to end up being half the market. They were originally targeting 25% by 2025. It's now 20%, and it'll be 25% within the next 12, 18 months, right? So everything is moving forward at a faster pace, basically. So that part of the Chinese economy is relatively booming. And what hasn't happened yet, but is going to start happening very soon, is the Chinese are going to start exporting electric vehicles on a massive scale. And it's going to be an absolute shock for Tesla and for a lot of other players. So right now, there's a thing called the SEAL, which is the new BYD Tesla 3 equivalent, right? In many ways, it's more advanced. They've actually created the body of the car, the floor of the car basically is now a structural component made from the battery. No one has ever done that before. And that's far more impressive than anything the Gigafactory is doing with a sort of single press on the metal thing. They're selling that into Japan starting in January next year. The price point is about a third lower than a Tesla 3, as it is in China. It's about $31,000 retail in China. Now, they can do that because they control the entire supply chain. And in fact, Tesla is already buying lithium phosphate batteries from CATL, but it's also buying batteries from BYD, almost certainly. The formal announcement is due. So you're getting Tesla buying, batteries and battery technology, because this is genuinely innovative technology. The BYD Blade battery, what CATL did in lithium phosphate, what they're trying to do in sodium-ion batteries, this is genuinely innovative. This is not copycat scale economy stuff. They did that to start with, and they've moved ahead very quickly indeed with huge investment in R&D. So they're starting to outcompete Panasonic and Samsung SDI and LG Chem and all these established players. And that's why Ford, 2 weeks ago, tied up with CATL, which is now going to build a big factory in the US to supply the Ford, because Ford is losing money on electric vehicles. And to get to its 88% margin target by mid-decade, they need cheaper batteries. So again, it goes back to that vertical integration price point issue. The lithium price might come back 15 to 20%. Who cares? Because the contract prices are still lagging so badly. They're going to go up 50, 60% from when they were last signed 2 or 3 years ago, even with a falling spot price. So I wouldn't obsess on the spot price, basically. And there will be correlated risk-off moves in miners generally, whether they're uranium, lithium, whatever, just in terms of the market and sentiment. But it's a great opportunity. There are very few proven ore bodies with a clear kind of pathway, runway to production in the next 5 to 10 years. They will have their hands bitten off in terms of OEM car makers looking to secure supply. And as I said, the contract pricing is what you focus on. It's a bit like iron ore a few years ago, as it moved from sort of spot to contract. The same thing's happening in lithium.
I'm throwing it back to you, Daniel. I have too many questions. It would go too far afield. We don't have enough time.
Yeah. It's really intriguing. So when I look across the broader space of lithium and the whole battery sort of world, like I say, like from our perspective, it looks like we're just still a little bit premature to kind of back up the truck, so to speak. we have a condition that formed earlier this year that is very similar to, say, sort of early 2019, but still just it's really hard to compare the two. The only other precedent might have been late 2014 in terms of just the washout in broader liquidity interest in that broader sector. And the initial sort of accumulation from larger money flows to sort of accumulating or reaccumulating positions in this sort of broader sector, the speculative crowd washed out in a similar way. Even now, they're very distrustful of this rally in a lot of the different conditions, in the lithium side of things, in the mining, and then in the battery users and car makers and all of this sort of thing. The fundamental health of all of these different companies, however, are pretty good, especially all of the, obviously, because pricing is still, cash flows are still very rich, et cetera, et cetera.
Well, this is it. And there's going to be M&A. There's going to be a lot of M&A support in all of this.
Yes, no,
and a lot of strategic investments, as I said, from car OEMs, whatever. I mean, look at China. So China's been in a bear market, right? You look at the relative performance of clean energy within China indices. So internet tech has been a horror story, dead cat bounce, whatever. But ultimately, you look at stocks like BYD, at Ganfeng, at Tianqi, at some of the wind stocks. They have all delivered very strong year-to-date positive returns. And that is relative strength that you have to respect. The market is going where the growth is, where the earnings surprises are, right? And where the upgrades are coming through. And it's all in that space. And, you look at stocks in the US, like I said earlier, I mean, when I look at energy, it isn't just lithium, it's also the entire supply chain that helps you use energy more efficiently. So for instance, if you're going to use lithium phosphate batteries, you think about copper prices, you've got to do something to make sure you use less copper in the harnessing for them, for cars, for instance, right? So, we're using 60, 80 kilograms of lithium per EV right now. We want to reduce that. We want to make higher energy density, less copper in the car. So stuff like Cilium kind of, if you look at what's happening in silicon carbide, which is the stuff that Wolfspeed's built a big plant for outside New York, or look at what onsemi's doing in power semis, these guys have got a fantastic 10-year secular growth story because they're helping car makers use materials more efficiently, right? So whether it's recycling or it's technologies which allow you to use all this stuff more efficiently in the car and improve your margins or avoid some of these bottlenecks, you've got a fantastic multiple-year secular tailwind. And it doesn't matter what happens to the wider market. onsemi just hit a new high. Wolfspeed, I'm certain, will later this year. These guys are in the sweet spot because they have a technology in the context of this electrification of car story, which is the next decade's mega story, where they have a lot to add in terms of value, and they have got huge pricing power, and they can sell anything they can make, basically. They're booked out forever. And there's a lot of Japanese companies in that space as well. There's loads of great secular growth stories out there, which, frankly, the rest of NASDAQ and what happens to the Fed and terminal rate and whether it's cuts rates next year or keeps them flat, it's kind of noise, because, as ever, there's always a bull market in something. And there's a bull market in this whole space right now beneath the surface.
Sean, the outlook is you're saying that new technology may come in the next decade. Sodium-ion batteries, maybe solid-state batteries.
Solid-state's probably more mid-2030s. Lithium-ion is still the only game in town for the next, say, 10 to 15 years.
10 to 15 years. Also recycling, 10 to 15 years.
Recycling needs, obviously, a pool of extant vehicles that are actually giving out their batteries. So you need to have millions and millions out there retiring to make that a big chunk of the market. So that's, as I said, if we meet all these targets and we start selling tens of millions of EVs a year, then by mid-2030s, and assuming governments are going to mandate recycling targets, which they will, I'm sure. I mean, most of the Chinese, it's interesting that Nissan recently with the Leaf in Japan put export controls on the Leaf because they want to own the battery. They want to keep the battery. So I think car makers will actually end up with a subscription type model where you rent the battery and you give it back at end of life, basically. So they control the material. That's one of the kind of shifts you're seeing. The Chinese have started this. Nissan's moving that way. One or two of the US guys are talking that way. So the entire model of how you sell a car, own a car, and where the real added value is all kind of shifting as well.
I was driving at what you just raised, that governments are going to be mandating something, perhaps because what I'm seeing is that there may not be enough time for Western
greenfield.
companies, Western mining companies, to commit to invest in mines if there's a deadline 10, 15 years from now, whereby the market
Exactly.
may be completely different. And so
But you-
perhaps then
yeah.
governments need to subsidize. Are
Yeah.
they doing that? I don't
No.
think they are.
Well,
At
that's the
least in the
mistake with the
West.
clean energy bill. The clean energy bill subsidized car makers selling EVs, but it didn't move down the value chain. And actually, the subsidy is contingent on domestic content, which is impossible to achieve. So what they should actually have done, if they thought intelligently about it, was to subsidize the mine development and subsidize the refining development.
And the refining.
Or, like they do in farming, in agriculture, set some sort of base floor price so that lithium can't go below X price over the next 10 years. We'll buy it into some sort of strategic reserve. We'll have an SPR for lithium, whatever, just to give miners and their investors the confidence to make these 10, 15-year commitments. That would have been a very intelligent thing to do.
I know in the late 1940s through the early 1960s, the United States did something like that for uranium.
Precisely,
Put in a
exactly.
floor. And I would think
Totally.
they should be doing the same, but I'm not hearing any Western governments doing that
And
at
it's
the moment.
incredible because that is less market intervention than throwing out $7,500 EV subsidies to GM and Ford. I mean, let them slug it out and let the best man win. The intervention should be to ensure the raw material supply is geopolitically protected from Chinese intervention, etc. Right? It's a national security issue ultimately, right?
Mhm.
And that I think they have completely missed the point. So the real danger in all this is that we don't get the supply of refining and lithium stuff coming through. The car makers never get these subsidies, so they're kind of like hugely competitive against Chinese imports of finished EVs. And you know, it's basically stillborn. It just doesn't really deliver on its promise, despite all the hype in the last few weeks. So I think it's a very flawed plan. I mean, it's a great statement of intent, and some of the solar subsidies and stuff are all great, but ultimately, I think in terms of this bottom layer, they've completely missed. I don't see how the market can solve this problem on its own, frankly.
Daniel, I was thinking, Sean just mentioned national security issue. I've been thinking that phrase, national security issue, during this interview. Do any of your market participants, are any of them governments or sovereign wealth funds, anything along the lines of serious long-term investors that can be in this market? Do you see anything like that in your market
I've got a couple
participants?
of oil sovereign wealth funds, you know, and the oil guys are obviously basically quite explicitly moving into technology to diversify and to hedge the long-term bets. The Saudis are doing that. The Gulf guys are doing that. And so for them, clean energy makes absolutely good sense because that is the threat to peak transportation demand, etc. So to have a portfolio which gives you upside exposure to that, of course, makes perfect sense. So a lot of my long-term investors, I'll tell you what's really happening is that a lot of big hedge funds and a lot of big family offices are now taking China out of the EM bucket and giving a separate China allocation. And within China, they're specifically creating a clean energy allocation, right? So that they're not seeing it as an EM story because at the end of the day, these companies are absolutely competitive with anything in Europe and the States in terms of the technology, the IP, etc. And so putting them in an EM basket is incredibly stupid. I think we have to move away from these benchmarks in this massive shift that we're currently seeing in terms of where the value is created. And so the smarter investors, the ones that are less constrained, are definitely now thinking there's a huge, broad pool of stocks in the battery space, in the EV space, in the mining space, etc., in China, which doesn't exist in Europe and the States. If we're going to have a clean energy portfolio, we've got no choice but to hold our noses, go into the Asian market, go into Hong Kong, and buy exposure to some of these names. And I think that's what's happening.
Daniel, do you want to react to anything that Sean said, or do you have anything to say regarding the timing and what you're looking for, triggers that may tell you, you said earlier that it may be premature according to you, the models and flows that you're seeing right now. Are there any triggers, markers that you're looking for?
So, firstly, I love Sean. This is fantastic.
Thank you.
Yes, it's very good. Everything he's saying completely rings true with a lot of what we're seeing. Now, if I were to use analogies, from a timing perspective, the clearest ones, I've just been looking through a whole bunch of stuff while you guys were continuing to talk, we had basically like a global growth, like the two biggest opportunities that came to accumulate positions in this space were the end of 2015 and then the end of 2019. If we ignore the COVID shutdown in 2020, and let's just, put that one aside because that was a little left field to the regular market sort of cycle or economic cycling of global conditions. With the benefit of hindsight, the most opportune times were late 15 and then late 19 to pick up positions. The beginning of both 2015 and 2019, we had a similar sort of construct in terms of the way. So we have these aggregated models, and I built them actually today for these sectors, just to make sure that I was seeing everything right around underlying liquidity. It's like order book depth, for example, in the S&P 500, bids and offers and all the rest of it. And that, on the one hand, it's a liquidity type indicator. But when we step back from a globally, so like a global complex adaptive system type perspective, it's almost like the inherent demand that the broader complex system is placing on any given market or commodity or whatever often will pick up in the liquidity first. And so liquidity is like an expression of interest in this market from the broader world, right? And as a result, when we look at these aggregated pictures, especially across industries, what we end up with is real-time or even leading barometers of, say, industry health. It's almost like real-time demand pictures is the secondary lot of information. And so that all of this sort of is ringing true in this space yet again. And if anything, if we have a repeat situation where, depending on how you peg it, the global growth cycle also, so the last two opportunities to accumulate positions, end of 15, end of 19, was basically the end or the bottoming of that sub-cycle of global growth. And we've had this 2 to 4 year-ish sub-cycle of growth conditions in the world, for the last 15 years. And presently, right now, it still seems like we're in a negative surprise environment in terms of decelerating growth or negative surprises to growth, especially because we've still got the central banking community still hiking into all of this and tightening.
Look, I do macro, that's my bread and butter, but I when it comes to these kind of things, we have baskets of stocks, that give thematic kind of active ETF type stuff, and I don't worry about this stuff because when the secular trend is this powerful, this is like 1984 and trying to buy into the personal IT revolution, right? Yep. You're at that early stage. You can see it happening. You're looking for software names, hardware names, go out by Microsoft, Apple lists, whatever. And yes, Volcker might be squeezing the life out of the economy with inflation, whatever, and it's a bear market. But ultimately, you've got this explosive energy coming through in terms of this mega trend. And I think that's where we're at. And, in our basket, for instance, which we did a new one recently, which is a materials transition basket, we've got a South African mining stock, $10 billion market cap. It's in precious metals, but it's moving into batteries and it's moving into recycling and it's moving into safe lithium supplies. It's cheap as chips. It's down 40% in a year. I mean, you can buy value stocks that give you exposure to this. If you go a bit left field, you don't have to buy there's a dozen lithium names in the market in the West, basically, if you don't want to go to the Chinese guys. But there's a hell of a lot of names in the recycling space, which are moving into batteries, which are moving into these adjacent areas. And when you look at lithium, wherever the supply comes from, be it taking a battery apart or digging it out of the ground, again, from the ESG perspective, it doesn't matter. It's what's the carbon footprint, what's the added value, what's the margin. And, there's one in Germany, which is, it's a smelter. It's a recycling company, which is moving into batteries and is potentially going to invest $500 million in a huge battery recycling factory in Germany, which is trading on a single-digit PE or multiple. I mean, there's cheap stocks out there the market hasn't alighted on because the ESG funds are generally pretty stupid. I mean, the fact is, I've never met an ESG fund manager who impressed me with the depth of their knowledge. They they basically skim along the surface and they never go a layer deep, let alone 2 layers deep. And that's where the opportunity currently is. And so put the macro to one side, look at those mega trends and assume the stupid money will find them. And when the stupid money finds them, that'll be like SaaS stocks in 2019.
Well, that's exactly numbers. The setup. The thing is that it's, if I had to guess, which is stupid to do, but I think we're going to get another opportunity to buy these at quite a discount still over the next 12 months. And it's just purely on macro slowdown, et cetera, whatever.
Well, but you got to be ready. And no one's ever brave enough when the moment comes. That's the problem. When the screen is horrible and red and like it was back in June, right? And everyone's like, oh my God, and everyone's downgrading their targets. So, I just think you got a money average in and you take a 5-year view and you say, look, this thing could be a multiple of, this could be a 10 bagger. And at the end of the day, once you're happy, the management has skin in the game, they have the skill to execute, it's going to actually happen and not fall by the wayside. I think you can just assume the demand is there. So to my mind, nobody able to produce lithium in the next 5 to 10 years at scale will have a problem shifting it at a great price. It's done deal. That's my takeaway. It is just, it is not going to be an oversupply. It's going to be how the hell do we get our hands on the material to reach these EV targets? That's I think a story which is still not fully understood.
Daniel, just to be mindful of Sean's time, do you have any final theme, topic, question you want to ask?
Not really. I think it's just very compelling. We didn't end up getting into what I thought we would do, but mostly because I don't think it's necessary. Like, it's fairly straightforward here.
Yeah. As I said, look for the adjacent opportunities. Don't just look at the lithium miners per se. The recycling stuff, companies reinventing themselves. There's a lot of companies reinventing themselves into lithium suppliers via stuff like recycling. And there's a lot of miners who don't have any lithium exposure right now, who are moving from legacy mining into lithium, into new energy. Find those guys because they will re-rate over time, okay? And the market, again, isn't very good at recognizing this until it stares them in the face, and then you get a big move. So there's 4 or 5 miners off the top of my head I could say, look, everyone knows Glencore's there. Everyone knows these big names are there, basically. Freeport, whatever, copper, all that story. But there's a lot of second and third tier guys now moving into lithium, moving into some of these green energy spaces, and they're not being recognized yet because they're just too low profile and they're not covered widely. So if you find those guys, I think you've got a value proposition with a free carry on the lithium re-rating.
Sean, can you tell our audience one more time where they can find you, how to contact you?
Well, I don't have them contacting me, but I am on Twitter at smaherlan on Twitter, and I do post some of the stuff I'm reading in terms of clean energy and energy transition stuff, whatever, up there. So feel free to follow me on Twitter and basically retweet stuff or sort of whatever. You're welcome to comment on that. But that's the only way I interact with the retail space. Everything else goes out, as I said, to the institutional kind of space and is all kind of regulated, I'm afraid.
Yeah, that's the modern way of contacting people. It's no longer phone calls or let alone emails. It's tweets and direct messages.
Exactly. So there we go. So no,
God
pleasure.
Forbid somebody voicemail.
Thanks, Emil, and thanks for inviting me.
Thank you very much, Sean.
Thank you, guys.